Hi, my name's Ian, and I'm the owner of Right Start Newcomer Services in Halifax, Nova Scotia, Canada. In today's video, we're going to talk about 5 super important accounts for new Canadians to know about. These accounts are going to help you achieve your lifetime financial goals. All right, let's get started. If you're like a lot of the newcomers I meet, you have a lot of financial goals. Most newcomers want to do things like buy a car, buy a house in Canada, send their children to university, and maybe even have a nice, comfortable retirement. And these are great goals, right? We all share the same types of goals for ourselves and our families, but they're really expensive in Canada. You know, Canada is not a cheap place, and these things cost a lot of money. But how much do they really cost? Let's find out. All right, for this activity, I'd like you to write down how much you think these things cost in Canada. How much for a used car, a home, university, a 4-year university program, and how much for retirement. So you can pause the video and write down your numbers. All right, let's see. The average used car in Canada is $35,000. The average home is $746,000. University costs $96,000. And retirement, they say, costs $1.4 million. Whoa, that's a lot of loonies. And if you don't have that kind of money, that's what investing is for. All right, I'm going to mention a few more things before we get to the accounts. The first is that, investing can be really confusing. And it's going to take a while to understand all of these accounts and all investing concepts. Don't worry, you learn a little bit at a time. The second one is that this is not financial advice in any way. So this is just information. If you make a bad investment decision, don't sue me, please. And finally, these accounts are different from like a checking account or a savings account that you might already have. These are investment accounts, so you can hold different investment products and financial products in these accounts besides just, cash or savings deposits. So you can hold things like stocks, bonds, mutual funds, exchange traded funds, GICs, which are guaranteed investment certificates, and there are some others that you can have. Now you may be asking yourself, where can I open an investment account? And the answer is really easy. So you can go to any of the banks in Canada. You can go to credit unions or Caisse Populaire, as they're called in Quebec. You can go to investment firms, or you could open an account with an online brokerage. The requirements to open these accounts are: 1, you have to be a resident of Canada for tax purposes. 2, you have to have a social insurance number. And 3, you have to be the age of majority in your province or territory, which is 18 or 19 years old. The first account we'll talk about is the basic account. It is the non-registered investment account. And this is a really flexible account that can be used for a variety of savings and investing purposes. So you could use this to buy a car, put it towards an education or even a home down payment or anything, actually. You can withdraw the money anytime, but there is one major downside, and that is you pay taxes on any investment gains. So things like capital gains, when you sell an investment for more than you paid, interest, and dividends. It's an okay account, but you have to pay taxes. All right, the second account is the tax-free savings account, and I really love this account. It's kind of like a non-registered investment account, but there's no taxes, as you can guess from the name, right? Tax-free means no taxes. You don't have to pay taxes on your investment gains. It's a great account. Everybody should get one, but there are a few rules. One rule is the contribution limit. You can only put in a maximum each year into this account. In this year, it's $6,000. But if you don't use that full amount, you can carry it forward to future years. If you do contribute too much to this account, you get fined by the government. Account number 3 is the Registered Retirement Savings Plan, or RRSP. This account is really great for people who are working and who want to save towards their retirement, but also for a home or for their education, their post-secondary education. So it's a pretty flexible account. When you contribute to an RRSP, your contributions are tax deductible, meaning that it will lower your income tax in the year you make the contribution. Also, your investments held in the RRSP are not taxed. So you can hold an investment for a long time. It won't be taxed until you take it out. So your withdrawals are taxed as income. Okay, so you will have to pay probably some income tax later on down the road when you take the money out. There is a limit. There is a limit to how much you can contribute, which is 18% of the last year's income. So once you do your tax return for the last year, we just completed it for 2021, now it's 2022, you'll get a piece of paper, a notice of assessment from the government. And that will say how much you can contribute to an RRSP. So you'll need that before you can open up your RRSP account. And it's also really important to understand that if you don't have income, you can't open an RRSP. You can carry forward contribution room. So if you don't put in the full amount this year, you can put more in next year and in future years. A few other things about RRSPs are important. One, a lot of employers have their own RRSP or RPP, which are registered pension plans for their employees. And I really suggest that you take advantage of these because your employer often will give you contributions as well. And it's free money, you might as well take advantage of it. Also, there are spousal RRSPs. Spousal RRSPs make a lot of sense if one person is earning more than their spouse or common law partner. The other two plans we mentioned briefly are the home buyer plan, which is super good for people who are buying their first home in Canada. Right, so this program, the home buyer plan, allows you to withdraw money from your RRSP to buy your first home in Canada. I think up to $35,000. And the second one is the lifelong learning plan, which allows you to take out up to $20,000 to pay for your college or university or post-secondary education. The catch is that you have to put the money back into the account or the government makes you pay tax on it. Number 4 is awesome. This is the Registered Education Savings Plan. This is super awesome for parents. And you know that university is expensive. So this is a way for you to save towards a child's education and have the government throw in some extra money. So it's a win-win-win situation. To open an account, there must be a beneficiary. So there must be a child, usually a child, who will benefit from opening this account. They must be a Canadian resident with a social insurance number. I mentioned that the government will help you save for your child's education, and there are 2 ways the government does that. The first is the Canada Education Savings Grant. The government will match your contributions, usually 20% of your contributions, up to $500 per year per child. So if you contribute $1,000 to your child's RESP, the government will contribute 200 or 20%, which is great, right? There is a maximum, so the maximum is 500 per year. And over a lifetime, it's 7,200 per child. If you qualify based on your income, so if you have a middle or lower income, your child or the child's family has a lower income, then there's an additional amount of the Canada Education Savings Grant, up to $100 per year that you may qualify for. There's another program called the Canada Learning Bond, which is also really great, and this one is especially for lower income families. This allows lower income families to start saving for a child's education, and they give a $500 payment in the first year, which is amazing. Then each other year that they qualify, it's an extra $100. So this is a wonderful plan. Make sure you ask for it, right? You can ask when you set up this account whether or not you qualify, fill out the forms, and the government will decide whether or not you qualify. There's no tax deduction, first of all. So the money you put in to the account is not tax deductible like an RRSP, so that kind of sucks. But there's no tax while the money's invested. When the child or the beneficiary withdraws the money, then you have to sort of think about taxes. So the contributions that you make as a parent, those are not taxable at all. So they can withdraw those and there's no tax. The amount the government gives you can be taxable. Also, your investment gains are taxable. So this is withdrawn by the beneficiary. They'll use it to pay for school and housing and all that stuff. But probably they're not going to end up paying any taxes or very little in taxes because one, they'll be a student, so they're probably not working at that point, so their income is going to be low. Secondly, there are tax credits and things like that for university, college tuition, books, and things like that. So probably there would be very, very little taxes for them to pay. Great account. If you have kids, please look into opening up an RESP. The fifth account is the RDSP, or Registered Disability Savings Plan. And this is a wonderful account for people who are saving for the long-term financial care of a person with a disability. Not just care, but life expenses. Maybe they need some help, things like that. So this is a great plan. It's similar a little bit to the RESP, or the Education Savings Plan, because the government will make contributions. And the government will help you save for this person with a disability. So the beneficiary of the RDSP must be a Canadian resident, must have a social insurance number, must be 59 years or younger, and receiving the disability tax credit. The two ways that the government will contribute to an RDSP are the Registered Disability Savings Grant, which will match contributions up to 300%. There is also the Canada Disability Savings Bond, which can be up to $1,000 per year or $20,000 over the lifetime, and that depends on the family income of the person with a disability. All right, so that's a great account. If someone in your family, someone you know, has a disability and you want to, maximize the amount of money that person will have for the rest of their life. Okay, so that's 5. We talked about 5. There's another one I want to mention. I'm really excited about this one. I know we didn't plan on more than 5, but here we are. This one is great for people wanting to buy a house in Canada. And it doesn't exist yet. Maybe it will by the time you're watching, but don't go to the bank and say, I want to open this right now because it doesn't exist yet. All right, this one is going to be called the Tax-Free First Home Savings Plan. Let me check if I got that right. Tax-Free First Home Savings Plan, FHSA. This has a lot of benefits. It will if it ever comes out. The first is that contributions are tax deductible, so like an RRSP. Second is that withdrawals are not taxed, like a tax-free savings account. So it has sort of a combination between the RRSP and TFSA. It's a great account. You can contribute up to $8,000 per year, up to a maximum of $40,000 that you can use to purchase a home in Canada. So keep your eye out. Maybe it will be available by the time you watch this video. It's a pretty exciting account for people who want to buy a home in Canada. I hope you learned something, and I hope this is a benefit to you. I'm really excited about investing. I love investing. I've been investing myself since I was, 15 years old. And I think it's an amazing way for you to build your future, right? You're putting money away now for something down the road. And it's really important that you get the right information at the beginning so you'll know what to do. Take care. If you like this video, like and subscribe. See you next time.